The Bank of England has just made a massive move. For the third time in 6 months, interest rates in the UK have been cut, dropping the base rate to 4.5%. If you have a mortgage, a savings account, or you're just trying to survive the cost of living in 2025, everything just changed. But here's the catch. While this sounds like good news on the surface, it's a hidden trap for a lot of people. For some households, this could mean instant relief. Monthly mortgage payments coming down, a bit more breathing room, and finally some light at the end of the tunnel. But for others, this cut could quietly eat away at their savings, lock them into the wrong deal, or leave them worse off by the end of the year. And the real danger? Most people won't realize which side they're on until it's too late. Banks are already adjusting their rates. Lenders are reshaping mortgage deals. Savings providers are cutting returns. And if you don't understand how this decision affects your specific situation, you could end up making a move now that costs you thousands later. I'm UK Money Guide, and today on UK Money Guide, we're breaking down exactly how much your monthly payments could drop, depending on your mortgage type. What's really happening to savings interest behind the scenes? And the one mistake you must avoid before the next rate review in March, a mistake that many people make every single rate cycle. We'll look at who actually benefits from this cut, who doesn't, and why doing nothing can sometimes be worse than making the wrong decision. I'll also walk you through the smart moves to consider right now, whether you're a homeowner, a saver, or somewhere in between. Because this rate cut isn't just a headline, it's a turning point. And by the end of this video, you'll know exactly how to position yourself on the right side of it. Let's break it down. Let's start with the big one, mortgages. The Bank of England cut the rate by 0.25%, bringing it down to 4.5%. If you're on a tracker mortgage, congratulations, you're the immediate winner. You'll likely see your monthly payment drop almost instantly. For an average £200,000 mortgage, this cut could save you around £30 to £40 a month. It doesn't sound like a fortune, but over a year, that's several £100s back in your pocket. Now, if you're on a fixed rate deal, nothing changes today. But, and this is a big but, if your deal is ending in the next 6 months, things are about to get very interesting. The lender price war is officially underway. Big names like Nationwide and Barclays are already sharpening their offers. And for the first time in a long while, we're seeing sub 4% mortgage deals starting to appear. This is where timing really matters. Pro tip: don't just wait for your current deal to expire and roll onto your lender's standard variable rate. That's one of the most expensive mistakes homeowners make. Most lenders allow you to lock in a new rate up to 6 months in advance. That gives you flexibility. If rates fall further, you can usually switch to a cheaper deal before completion. If rates rise, you've already protected yourself. And one more thing people often overlook: even if you're not remortgaging yet, this is the perfect moment to review your options. Check your loan to value and see whether overpaying a little now could unlock a better rate later. Small moves here can make a huge difference over the life of your mortgage. Up next, let's talk about the other side of this decision, what this rate cut means for your savings, and why many savers could be the real losers this time around. Now for the bad news. Savers, you need to move fast. When the base rate drops, banks are incredibly quick to slash the interest they pay on easy access accounts. If you've got money sitting in a high street bank, earning 4% or even 5%, expect an email very soon telling you that rate is being cut, sometimes with barely any notice at all. This is the beginning of the end of the high-interest era for savers. The days of doing nothing and still earning a decent return on your cash are fading fast. And if inflation stays sticky while savings rates fall, the real value of your money could quietly shrink month after month. That's why if you've got cash you don't need immediate access to, now is the moment to take action. Fixed-term savings accounts and cash ISAs are still offering some of the best rates we've seen in years. By locking your money in now, You can effectively guarantee today's higher rates for the next 12, 18, or even 24 months, even if the Bank of England cuts rates again later this summer. But this isn't about chasing the headline rate alone. You also need to think about access, tax, and flexibility. Using your ISA allowance can protect your interest from tax, and splitting your savings between easy access and fixed accounts can give you the best of both worlds, security and liquidity. The key mistake savers make is waiting, assuming they'll sort it later. By the time later comes, the best rates are usually gone. So if you've been sitting on cash, this rate cut should be your signal to review where your money is parked before the banks move the goalposts again. Next up, we'll look at the one mistake that both borrowers and savers are making right now, and why getting it wrong before the March rate review could undo all the benefits of today's cut. So why did they cut rates when inflation is still a bit bumpy? Simple answer: the Bank of England is more worried about growth than inflation right now. They've slashed the UK's growth forecast for 2025 to just 0.75%, which is dangerously close to stagnation. In plain English, the economy isn't moving enough, and they want to give it a push. Cutting interest rates is one of the fastest ways to do that. Cheaper borrowing encourages people to spend, businesses to invest, and households to feel a bit more confident opening their wallets. It's not about celebrating, it's about preventing things from slowing down even further. But this is a very delicate balancing act. Markets are currently pricing in at least 2 more rate cuts before the end of the year. If that plays out, we could be looking at a base rate of around 4.0% by Christmas. That's why lenders are already moving ahead of the Bank of England. They're trying to get ahead of where rates might be, not where they are today. However, this is where the risk comes in. The Bank of England has been very clear: inflation isn't beaten yet. They've warned it could climb back up to 3.7% later this year, largely due to volatile energy prices and global supply pressures. If that happens, the rate-cutting cycle could pause or even stop completely. That's why nothing is guaranteed. Anyone assuming rates will keep falling automatically could be in for a shock. The BoE is trying to support growth without reigniting inflation, and that leaves very little room for mistakes. Which is exactly why the decisions you make now, whether it's fixing a mortgage, locking in savings, or sitting on the sidelines, matter more than they have in years. Timing, flexibility, and understanding the risks are everything in this next phase. And finally, let's pull all of this together. What should you actually do next? And how do you avoid being caught on the wrong side of the next rate decision?
So, what's the bottom line? 1. Mortgage holders. Check your revert to date now, not later. If your fix ends in the next 6 months, see whether a sub-4 deal makes sense for you and lock in an option early. Even if you don't switch, having a rate secured gives you leverage and peace of mind in a very uncertain market. 2. Savers. Do not assume your current rate is safe. Shop around for a fixed-rate savings account or cash ISA while today's offers are still on the table. Once banks start cutting, they rarely move rates back up quickly, and waiting could mean locking in a much worse deal. 3. Everyone else. Mark March 20th in your calendar. That next Bank of England meeting could set the tone for the rest of 2025. Whether rates fall again or pause, markets will react fast, and the best deals often disappear just as quickly. The big takeaway here is this: doing nothing is still a decision, and in a changing rate environment, it's often the most expensive one. If this guide helped you make sense of the noise, hit that like button and subscribe to UK Money Guide. I'll be tracking every move the Bank of England makes, breaking it down in plain English, and helping you stay one step ahead without the jargon. And I'd love to hear from you. Comment below. Is your mortgage fixed or variable? Are you planning to switch this year, or sit tight and wait it out? Thanks for watching, and I'll see you in the next one.